Welcome back to your personal finance classroom, where we break down your money questions to make it easy for you to live your best life. Don't forget to subscribe and hit that notification bell so you can be notified when new videos come out. And if you found this video helpful, don't forget to like it. Today, we're talking about the most reliable way to pay off debt. Whether you have student loan debt haunting you from your college years, or you've racked up credit card debt that's become a challenge to pay down, you have options. You won't be in debt forever, and with the right strategy, you can pay it off as quickly as possible. Debt is the amount of money borrowed by an individual for a certain time period to be returned along with interest. There are different types of debt that can typically be broken down into two categories: secured debt and unsecured debt. Secured debt is also known as collateralized debt. This type of debt is when there's something of value that backs up your debt. So for example, with a car loan, the car would be the collateral. Or with a mortgage, the home would be collateral. In the event that the borrower doesn't repay the loan, the car or the home could be taken away. Unsecured debt is when the borrower has a contract with the lender to repay the money. If the borrower does not pay, the lender can go to court to get the money owed. These are things like student loans, credit card bills, medical bills, or personal loans. Unsecured debt tends to have a higher interest rate than secured debt because there is no collateral. Not all debt is bad. If you are using debt to help build your wealth or improve your financial situation, debt becomes a tool that you leverage. As long as you can afford the payments, the interest rates are low, and there are long-term benefits, you can consider it good debt. Bad debt, on the other hand, is borrowing money to buy things you can't afford or that don't have value. These are things like high credit card debt, which can hurt your credit score. And whether you have good debt or bad debt, let's talk about how to reliably pay off your debt. Approach 1, pay more than the minimum or standard payment. A great way to pay off your debt is to start paying more than the minimum or the standard payment. This may sound like an obvious one, but let me explain why this is so important. First, let's talk about this in terms of loan payments. Whether we're talking about a personal loan, student loan, auto loan, or mortgage, the payment breaks down the same. Your monthly payment goes to the principal balance and to interest. Principal is the money you originally agreed to pay back, and interest is the cost of borrowing the principal amount. So, for example, if you have a $25,000 loan with a 6% interest rate and a 10-year repayment period, it would mean that you owe a total of $33,306 over the course of those 10 years, and your monthly payments are at $278 a month. But part of that $278 goes to interest. If you were to make additional principal-only payments towards your loan, that money would go towards just the principal, and you could pay off your loan a lot faster. Using the example from above, if you made extra payments each month to reach a $438 monthly payment, you could pay off your loan in 5 years instead. The total you would pay is $29,000 instead of $33,306. Ultimately, you're paying less money when you can make bigger payments. If you can't afford to pay a significant amount more, really anything helps, and any time taken off your loan length will save you money and interest. And then when it comes to credit card debt, if you're only paying the minimum due, interest will build up. A lot of the time, just paying the minimum due will barely take care of last month's interest. And if you're continuing to use the card, it's easy to fall further and further behind. Interest is calculated on the remaining principal. So paying off the principal faster means less interest is calculated, which means your debt is not only paid off faster, but it's cheaper. Be sure to check out our budgeting video, which we'll link in the description, where we walk you through creating an effective budget that will allow you to put more money away towards debt each month. If you have more than one loan or credit card with different balances and interest rates, there are 3 strategies you can consider to pay these off as quickly as possible. The first is what's called the Snowball method. The Snowball method is where you put the focus on paying off the smallest debt balance first, and then take the money that you previously put towards that debt and apply it to the next smallest balance, and so on until all of your debts are paid off. You continue to make payments on everything else, but put more funds towards the smallest first. As you roll the payments from the smallest balance to the next, the amount snowballs and gets larger and larger as the rate of debt paydown is accelerated. This strategy works best for those that need help to stay on track because you get the achievement of paying off your debt quicker. The alternative would be the Avalanche method. This strategy has you paying off balances with higher interest first. You'll continue to make payments on all of your debt, but put more funds towards the debt balance with the highest interest. Then, when you've accomplished that, you'll apply those monthly payments to the debt with the next highest interest rate. This method is cheapest overall, but it doesn't have the same quicker gratification as the Snowball method. The third strategy you can consider is debt consolidation. With this method, your debts, including your credit card bills and other loan payments, are rolled into one loan or monthly payment. This strategy works for both simplifying your debt and potentially offering you a lower interest rate. If you choose this strategy, do your research and find the right loan with the lowest interest rate to consolidate your debt. Then you'll have just one monthly payment to worry about. Approach number 2, split your payments into smaller payments. We talked about the fact that your payments consist of you paying towards the principal balance and also interest. This approach takes that into consideration too. With this approach, you'll make the same amount of payment you always do, just split in two. So say your monthly payment is $400. On the first of the month, you'll pay $200, and then on the 15th, you'll make another $200 payment. You've paid the same amount you always have, but with the added benefit of lower interest over time. Since the interest is calculated off of the remaining principal balance, paying part of it up front means that the next payment is calculating interest off of a lower balance because you've already made a payment. You aren't giving interest a chance to grow as quickly. This works for student loans, personal loans, mortgage payments, and auto loans. Since interest doesn't work the same way for your credit card debt as it does loans, you can consider making multiple payments. Try paying the minimum due twice a month to help you pay down your credit card debt quicker. Approach number 3, refinance your loans. This approach works for loans like an auto loan, mortgage, or student loan, and it's especially effective if you have a good credit score. Refinancing is revising and replacing the terms of an existing loan agreement. It's typically done by the borrower in exchange for better terms on the loan, like a better interest rate, a lower monthly payment, or a shorter payment period, which can mean less interest paid over the life of the loan. We will note that this approach works best if there's a favorable interest rate environment. At the time of recording this video in March 2023, there have been numerous interest rate hikes by the Federal Reserve. This means that borrowers will continue to see higher interest rates on mortgages, credit cards, and personal loans. If you're considering refinancing, keep an eye on interest rates and inflation to know when the best time to refinance is. Approach number 4, consider a balance transfer. While refinancing works for loans, a balance transfer can be a great option for credit card debt. A balance transfer is where you apply for a card with a 0% interest rate or annual percentage yield, APY, for the first year or longer. Then you'll transfer the balance or portion of the balance with a high interest rate to the card with the 0% APY for the first year. We'll note that there's typically a transaction fee of 3 to 5% to transfer the balance to the new card. But the fee might be worth it in some cases because this approach can help prevent interest accruing on the debt that you're unable to pay off in full. It gives you the opportunity to make payments towards the principal without being buried in interest as time goes on. As we discussed, credit cards are unsecured debt, so they tend to have higher interest rates that can range from 15 to 30%. Pausing accruing interest can give you the opportunity to make a bigger dent in your debt. Approach number 5, bring in extra money. If you're in debt, a lot of these approaches can help you pay it down. But what can really make a big difference is bringing extra money in. Consider making extra debt payments when money comes into your life through things like pay raises, bonuses, tax returns, or even birthday money. You can also bring in extra income to pay down debt via a second job or starting a side hustle. We live in a world where you can do a side hustle without leaving your home. Consider your skills where they fit into things like freelancing, starting a blog, opening an Etsy shop, or becoming a virtual assistant. Figure out what's the best option for you and your skills that will allow you to make money from home. And if none of those work for you, you can always pick up something in person like photography, driving for a ride-sharing company, dog walking, or tutoring. Another way to make extra money is to sell your stuff. You can easily sell old video game consoles, nice clothes you don't wear, or the exercise equipment that you just don't use anymore. You can sell your stuff online at Facebook Marketplace or other local markets, and for clothing, consider ThredUp or Poshmark. You could even set up a yard sale to sell stuff of value you don't use anymore for extra cash. Make it a point for this income to go directly to debt paydown. It's easy to spend more money when you're making more money, but keep your goal of debt paydown in mind. And finally, approach number 6, avoid creating new debt. This is arguably the most important tactic. It might seem like an obvious one, but as human beings, we're creatures of habit. And if pulling out the credit card to swipe for something you want is the habit, it can be easy to continue to do that until we find ourselves right back where we started. Make a budget for yourself and check in with it regularly to make sure you're on top of your finances. The key is to be consistent and create better habits. Your future self will thank you. Check out our video on how to make a budget for a simple and helpful way to create a budget that doesn't require you to skip out on your morning latte. Don't forget to like and subscribe. We'll be back Wednesdays and Fridays with new personal finance lessons for you.